Welcome to this review of mortgage loan origination activities, a key part of the SAFE MLO exam brought to you by Birdsy, your AI-powered study partner. In this video, we'll cover the loan application and key disclosures, credit, income, and asset verification, and ratios, appraisals, and collateral review. Be sure to like and subscribe for more exam prep, and don't miss what's happening in the lower corner. It could be key to passing your exam. Let's get started.
Mortgage loan origination activities, application process, and 1003. What is the primary purpose of the 1003 form in the mortgage application process? Is it A, to determine the interest rate for the loan, B, to gather borrower information for loan evaluation, C, to finalize the loan agreement, or D, to calculate the loan-to-value ratio? The answer is B, to gather borrower information for loan evaluation. The 1003 form, or Uniform Residential Loan Application, is primarily used to collect the borrower's financial and personal information necessary for evaluating and processing a mortgage loan application. Which section of the 1003 form is used to disclose the borrower's employment information? Is it A, Section 4, B, Section 5, C, Section 6, or D, Section 7? The answer is A, Section 4. Section 4 of the 1003 form is dedicated to collecting detailed employment information, including employer names, addresses, positions held, and duration of employment.
Have you noticed the code in the bottom corner? Next time you're stumped, take that code to birdsy.ai for immediate help and a free study session with Birdsy, your personal AI study partner. Plus, you'll get access to hundreds of additional questions, helping you move closer to passing your exam with confidence. The next time you're feeling unsure or stuck, give it a try.
In the mortgage application process, what is the significance of the borrower's debt-to-income ratio? Is it A, it determines the loan term, B, it influences the interest rate, C, it assesses the borrower's repayment ability, or D, it sets the loan-to-value ratio? The answer is C, it assesses the borrower's repayment ability. The debt-to-income ratio is crucial as it helps lenders assess a borrower's ability to manage monthly payments and repay debts, influencing loan approval decisions. What information is typically verified during the mortgage application process using the 1003 form? Is it A, only the borrower's credit score, B, only the property's value, C, only the borrower's tax returns, or D, income, employment, assets, and liabilities? The answer is D, income, employment, assets, and liabilities. Verification during the mortgage application process includes confirming the borrower's income, employment, assets, and liabilities to ensure the information provided is accurate and reliable. Which of the following is a key characteristic of the Uniform Residential Loan Application? Is it A, standardized format for consistency, B, varies significantly between lenders, C, primarily used for commercial loans, or D, optional for mortgage applications? The answer is A, standardized format for consistency. A URLA is standardized to ensure consistency and comprehensiveness in collecting borrower information, facilitating the mortgage underwriting process across different lenders. Disclosures and timing requirements. What is the required timeframe for providing the loan estimate to a borrower after receiving a mortgage loan application? Is it A, within 1 business day, B, within 3 business days, C, within 5 business days, or D, within 7 business days? The answer is B, within 3 business days. The loan estimate must be provided within 3 business days of receiving a mortgage loan application. This requirement ensures borrowers have timely information to compare loan offers. Which document is required to be provided to the borrower at least 3 business days before closing a mortgage loan? Is it A, loan estimate, B, initial escrow statement, C, closing disclosure, or D, notice of right to cancel? The answer is C, closing disclosure. The closing disclosure must be provided at least 3 business days before closing. This ensures borrowers have enough time to review final loan terms and costs. What is the purpose of the home loan toolkit provided during the mortgage application process? Is it A, to help borrowers understand the home buying process, B, to provide a detailed loan amortization schedule, C, to list all potential lenders, or D, to explain the tax implications of home ownership? The answer is A, to help borrowers understand the home buying process. The Home Loan Toolkit helps borrowers understand the home buying process, loan options, and costs. It is designed to aid informed decision-making throughout the mortgage process. When must a revised loan estimate be provided to a borrower if there are changes in loan terms or fees? Is it A, within 1 business day of the change, B, within 2 business days of the change, C, at the time of closing, or D, within 3 business days of the change? The answer is D, within 3 business days of the change. A revised loan estimate must be provided within 3 business days of a change in circumstances affecting the loan terms or fees, ensuring borrowers are informed of significant changes. What is the purpose of the right to rescind notice provided to borrowers in certain mortgage transactions? Is it A, to confirm the borrower's acceptance of loan terms, B, to allow borrowers to cancel the transaction within 3 days, C, to inform borrowers of their payment schedule, or D, to disclose the interest rate lock period? The answer is B, to allow borrowers to cancel the transaction within 3 days. The right to rescind notice allows borrowers to cancel certain mortgage transactions within 3 business days, providing a safeguard against rushed or pressured decision-making. Credit Report Review. Which of the following is the primary purpose of reviewing a borrower's credit report during the mortgage loan origination process? Is it A, to assess the borrower's credit worthiness, B, to verify the borrower's employment history, C, to determine the borrower's income level, or D, to establish the value of the property? The answer is A, to assess the borrower's creditworthiness. Reviewing a borrower's credit report helps assess their creditworthiness, determining the risk level associated with lending them money. This review informs decisions about loan approval and interest rates. What is the significance of the debt-to-income ratio found in a credit report? Is it A, it shows the borrower's total assets, B, it helps determine the borrower's ability to manage additional debt, C, it provides the borrower's employment stability, or D, it indicates the borrower's credit score? The answer is B, it helps determine the borrower's ability to manage additional debt. The debt-to-income ratio indicates the percentage of a borrower's income that goes toward debt payments, which helps lenders assess their ability to manage additional debt. How can discrepancies in a credit report impact the mortgage loan origination process? Is it A, they automatically lead to loan denial, B, they are ignored if the borrower has a high credit score, C, they require investigation and resolution, potentially delaying the process, or D, they result in immediate approval with conditions? The answer is C, they require investigation and resolution, potentially delaying the process. Discrepancies in a credit report can delay the loan process, as they require investigation and resolution to ensure accurate assessment of the borrower's creditworthiness. Why is it important for a mortgage loan originator to verify the accuracy of a borrower's credit report? Is it A, to ensure the borrower receives the lowest interest rate, B, to increase the borrower's credit score, C, to expedite the loan approval process, or D, to make decisions based on correct information? The answer is D, to make decisions based on correct information. Verifying the accuracy of a credit report ensures that decisions are based on correct information, preventing potential errors that could affect loan approval and terms. What role does a borrower's credit score play in the mortgage loan origination process? Is it A, it determines the borrower's employment status, B, it influences loan eligibility and interest rates, C, it provides a detailed account of the borrower's financial history, or D, it guarantees loan approval? The answer is B, it influences loan eligibility and interest rates. A borrower's credit score is a critical factor in determining loan eligibility, interest rates, and terms, reflecting their creditworthiness and risk level for lenders.
If you're finding this helpful, please take a minute to like this video and subscribe to our channel for more practice exams, useful tips, and complimentary study sessions with Birdsy.
Income and asset verification. What is the primary purpose of verifying a borrower's income during the mortgage loan origination process? Is it A, to assess the borrower's ability to repay the loan, B, to determine the property's market value, C, to verify the borrower's employment status, or D, to calculate the loan's interest rate? The answer is A, to assess the borrower's ability to repay the loan. Verifying a borrower's income ensures they have the financial ability to repay the loan. This step is crucial for assessing the borrower's creditworthiness and reducing the lender's risk of default. Which document is most commonly used to verify a borrower's income? Is it A, bank statements, B, pay stubs, C, credit reports, or D, property appraisal? The answer is B, pay stubs. Pay stubs are frequently used to verify a borrower's income as they provide a detailed record of earnings and deductions, reflecting the borrower's current financial situation. How can a self-employed borrower verify their income for a mortgage application? Is it A, pay stubs, B, employment verification letter, C, tax returns, or D, bank statements? The answer is C, tax returns. Self-employed borrowers typically use tax returns to verify income, as these documents provide a comprehensive financial overview, including all sources of income and deductions. What role do asset verifications play in the mortgage loan origination process? Is it A, to determine the loan's interest rate, B, to assess property value, C, to verify employment status, or D, to confirm financial reserves for loan approval? The answer is D, to confirm financial reserves for loan approval. Asset verification confirms the borrower's financial reserves, ensuring they have sufficient funds for down payments, closing costs, and reserves, which is crucial for loan approval. Which of the following is a key factor when verifying a borrower's assets? Is it A, liquidity of the assets, B, the borrower's credit score, C, the property's location, or D, the lender's interest rate? The answer is A, liquidity of the assets. Liquidity of assets is crucial as it indicates how quickly a borrower can access funds. Liquid assets are essential for covering immediate financial needs like down payments. DTI, LTV, and other key ratios. What does the debt-to-income ratio measure in the context of mortgage loan origination? Is it A, the proportion of a borrower's monthly income that goes towards paying debts. B. The percentage of a property's value that is financed by a mortgage. C. The total amount of a loan compared to the borrower's net worth. Or D. The annual interest rate on a mortgage loan. The answer is A. The proportion of a borrower's monthly income that goes towards paying debts. The DTI ratio measures a borrower's ability to manage monthly payments and repay debts. It compares monthly debt payments to gross monthly income, helping lenders assess financial stability. How is the loan-to-value ratio calculated? Is it A. By dividing the total loan amount by the borrower's annual income? B. By comparing the interest rate to the loan amount? C. By dividing the loan amount by the appraised property value? Or D. By subtracting the down payment from the purchase price? The answer is C. By dividing the loan amount by the appraised property value. LTV ratio is calculated by dividing the loan amount by the appraised property value or purchase price, whichever is lower. It helps lenders assess risk and determine mortgage insurance needs. Which of the following is a key factor in determining a borrower's eligibility for a mortgage based on their DTI ratio? Is it A. The borrower's employment history? B. The borrower's monthly debt payments compared to their gross income? C. The total amount of the borrower's savings? Or D. The borrower's credit score? The answer is B. The borrower's monthly debt payments compared to their gross income. Lenders typically look for a DTI ratio below 43% for qualified mortgages, as it indicates the borrower can manage additional debt without financial strain. What is a common impact of a high loan-to-value ratio on a mortgage application? Is it A. Higher down payment requirements? B. Lower interest rates? C. Increased borrower credit score requirements? Or D. The need for mortgage insurance? The answer is D. The need for mortgage insurance. A high LTV ratio often requires mortgage insurance, as it indicates higher risk to lenders due to lower borrower equity in the property. Why is the housing expense ratio important in mortgage underwriting? Is it A. It helps lenders assess if a borrower can afford monthly mortgage payments? B. It determines the borrower's creditworthiness? C. It calculates the total debt obligations of a borrower? Or D. It evaluates the value of the property being purchased? The answer is A. It helps lenders assess if a borrower can afford monthly mortgage payments. The housing expense ratio, or front-end ratio, measures the percentage of income used for housing expenses. It helps lenders ensure borrowers can afford mortgage payments without financial strain. Title, appraisal, and collateral. What is the primary purpose of a title search in the mortgage loan origination process? Is it A. To determine the property's market value? B. To identify any legal claims or liens on the property? C. To assess the borrower's creditworthiness? Or D. To verify the accuracy of the loan application? The answer is B. To identify any legal claims or liens on the property. A title search is conducted to uncover any legal claims or liens on the property, ensuring the lender and buyer receive a clear title. This step is crucial to prevent future legal disputes. Which of the following is not typically considered collateral in a mortgage loan? Is it A. The house being purchased? B. A commercial building? C. A personal vehicle? Or D. A vacant land plot? The answer is C. A personal vehicle. Collateral in a mortgage loan is usually the property being purchased. Personal items like vehicles are not typically used as collateral for mortgage loans. What role does an appraisal play in the mortgage loan process? Is it A. It provides an estimate of the property's market value? B. It verifies the borrower's employment status? C. It checks the property for zoning compliance. Or D. It ensures the property has no liens. The answer is A. It provides an estimate of the property's market value. An appraisal provides an unbiased estimate of the property's market value, helping lenders ensure the loan amount is appropriate relative to the property's worth. Why is it important for the lender to hold a first lien position on the collateral? Is it A. to increase the loan interest rate, B. to reduce the property insurance costs, C. to expedite the loan approval process, or D. to ensure the lender is the primary claimant in case of default? The answer is D. to ensure the lender is the primary claimant in case of default. Holding a first lien position ensures the lender is the primary claimant in case of default, giving them the first right to proceeds from the sale of the collateral. What is the significance of a clear title in the mortgage loan process? Is it A. It ensures there are no legal disputes or claims against the property, B. It guarantees the property's market value will increase, C. It confirms the borrower's credit score, or D. It verifies the property's structural integrity? The answer is A. It ensures there are no legal disputes or claims against the property. A clear title indicates there are no legal disputes, liens, or claims against the property, ensuring the lender and buyer can proceed without risk of future ownership challenges. Processing and underwriting steps. What is the primary purpose of a credit report in the mortgage loan underwriting process? Is it A. to evaluate the property's market value, B. to assess the borrower's creditworthiness, C. to determine the loan's interest rate, or D. to verify the borrower's employment status? The answer is B. to assess the borrower's creditworthiness. A credit report provides the lender with a detailed history of the borrower's credit behavior, helping assess their creditworthiness and ability to repay the loan. It includes information like payment history, credit utilization, and outstanding debts. Which document is primarily used to verify a borrower's income during the underwriting process? Is it A. pay stubs, B. bank statements, C. credit report, or D. title insurance? The answer is A. pay stubs. The borrower's income is typically verified using pay stubs, which provide evidence of salary and employment status. This helps the lender assess the borrower's ability to repay the mortgage loan. What role does the debt-to-income ratio play in mortgage underwriting? Is it A. it determines the loan's interest rate, B. it verifies the borrower's employment status, C. it assesses the borrower's ability to manage monthly payments, or D. it appraises the property's value? The answer is C. It assesses the borrower's ability to manage monthly payments. The DTI ratio helps lenders assess a borrower's ability to manage monthly payments and repay debts. A lower DTI indicates a better balance between income and debt, reducing the risk of default. Why is an appraisal required during the mortgage loan process? Is it A. to verify the borrower's credit score, B. to assess the borrower's income stability, C. to ensure compliance with zoning laws, or D. to determine the property's market value? The answer is D. to determine the property's market value. An appraisal is conducted to determine the fair market value of the property, ensuring the loan amount is appropriate for the property's worth. It protects the lender from lending more than the property is worth.
Stuck on a question? Just think of the Birdsy link in the description as your friendly neighborhood superhero, swooping in to save the day with answers. Feel free to explore it now and return to continue. Simply hit pause, and we'll be waiting when you get back.
Closing and post-closing activities. What is the primary purpose of the closing disclosure in a mortgage loan transaction? Is it A, to provide a summary of the borrower's credit score, B, to ensure borrowers understand loan terms and closing costs, C, to assess the property's market value, or D, to finalize the mortgage application process? The answer is B, to ensure borrowers understand loan terms and closing costs. The closing disclosure provides a detailed account of the loan terms, projected monthly payments, and total closing costs, ensuring transparency and understanding for the borrower before finalizing the mortgage. Which document is typically reviewed during the post-closing audit to ensure compliance with underwriting guidelines? Is it A, the borrower's employment verification, B, the property appraisal report, C, the loan file, or D, the title insurance policy? The answer is C, the loan file. The loan file is thoroughly reviewed in a post-closing audit to verify adherence to underwriting guidelines, ensuring the loan meets all regulatory and lender-specific requirements. What is a key responsibility of the closing agent during the mortgage loan closing process? Is it A, ensuring all documents are signed and funds are distributed, B, providing financial advice to the borrower, C, verifying the borrower's employment status, or D, conducting the property appraisal? The answer is A, ensuring all documents are signed and funds are distributed. The closing agent is responsible for ensuring all documents are signed and funds are distributed properly, facilitating the legal transfer of property ownership from seller to buyer. Which party is typically responsible for recording the mortgage and deed after closing? Is it A, the real estate agent, B, the title company, C, the lender, or D, the borrower? The answer is B, the title company. The title company usually handles the recording of the mortgage and deed with the local government to ensure public record accuracy and protect property rights. Advertising rules and prohibited practices. What is one of the key requirements for mortgage advertisements under the Truth in Lending Act? Is it A, include the lender's logo, B, offer the lowest possible interest rate, C, clearly disclose terms available to consumers, or D, provide a free credit report? The answer is C, clearly disclose terms available to consumers. The Truth in Lending Act requires that any advertisement for credit must clearly and conspicuously disclose terms that are actually available to the consumer, ensuring transparency and fairness in lending practices. Which of the following is prohibited in mortgage loan advertisements according to federal regulations? Is it A, implying a government affiliation, B, listing APR alongside interest rates, C, including contact information of the lender, or D, using comparative rates? The answer is A, implying a government affiliation. Federal regulations prohibit the use of misleading terms in mortgage advertisements, such as suggesting a false government affiliation or using deceptive rates that are not available to the consumer. Under the Mortgage Acts and Practices Rule, what must be avoided in mortgage advertisements? Is it A, detailed fee breakdowns, B, misrepresentation of terms, C, use of testimonials, or D, highlighting tax benefits? The answer is B, misrepresentation of terms. The MAP rule prohibits any misrepresentation in mortgage advertising, ensuring that all claims made are truthful and not misleading to protect consumers from deceptive practices. What is an example of a misleading practice in mortgage advertising? Is it A, offering variable interest rates, B, promoting low closing costs, C, emphasizing quick approval processes, or D, advertising a fixed rate that can change? The answer is D, advertising a fixed rate that can change. Misleading practices include advertising a fixed rate when the rate can change, which can deceive consumers about the stability and predictability of their mortgage payments. Fraud detection and red flags. Which of the following is a red flag indicating potential mortgage fraud during loan origination? Is it A, consistent employment history, B, sudden change in employment, C, steady income growth, or D, valid Social Security number? The answer is B, sudden change in employment. A sudden change in employment, especially if it's unexplained or inconsistent with the borrower's past, can be a significant red flag for mortgage fraud. It may indicate falsified information to qualify for a loan. What might an unusually high appraisal value indicate in the context of mortgage fraud detection? Is it A, appraisal fraud, B, legitimate market increase, C, clerical error, or D, high demand in the area? The answer is A, appraisal fraud. An unusually high appraisal value can suggest appraisal fraud, where the property's value is inflated to secure a larger loan amount, benefiting the borrower or a third party. Which scenario is a potential indicator of identity theft in mortgage applications? Is it A, applicant's name matches credit report, B, stable address history, C, variations in name or Social Security number, or D, consistent employment verification? The answer is C, variations in name or Social Security number. Variations in the applicant's name or Social Security number can indicate identity theft, where someone uses another's identity to apply for a mortgage without their knowledge. What is a common red flag related to income documentation in mortgage applications? Is it A, verified tax returns, B, inconsistent pay stubs, C, regular bank statements, or D, employer contact information provided? The answer is B, inconsistent pay stubs. Altered or inconsistent income documentation, such as fake pay stubs or unverified employment, can indicate income misrepresentation, a common form of mortgage fraud. Record-keeping and compliance documentation. Which document is crucial for verifying a borrower's ability to repay a mortgage loan? Is it A, credit report, B, debt-to-income ratio, C, employment verification, or D, appraisal report? The answer is B, debt-to-income ratio. The debt-to-income ratio is a key document that assesses a borrower's ability to repay by comparing monthly debt payments to gross monthly income. What is the primary purpose of the loan estimate form in mortgage loan origination? Is it A, to verify borrower's employment, B, to assess property value, C, to provide loan terms and costs, or D, to finalize loan approval? The answer is C, to provide loan terms and costs. The loan estimate form provides borrowers with important details about the loan terms, closing costs, and is intended to help consumers compare offers. How long must a mortgage lender retain records of compliance with federal regulations? Is it A, 3 years, B, 5 years, C, 1 year, or D, 10 years? The answer is A, 3 years. Federal regulations generally require lenders to retain records for at least 3 years to ensure compliance and facilitate audits. What is the significance of the closing disclosure in the mortgage process? Is it A, it assesses credit risk, B, it verifies employment, C, it estimates loan costs, or D, it details final loan terms? The answer is D, it details final loan terms. The closing disclosure provides final details about the loan terms and costs, ensuring borrowers understand their financial commitments before finalizing the mortgage.
Thanks for joining us today. If you found this video helpful, subscribe to our channel for more practice exams, tips, and tricks. And don't forget to visit birdsy.ai for complimentary study sessions with Birdsy, your AI-powered study partner.